and welcome to this week's market update. Latest news. Starting with some good news, it was announced this Monday that the United States and China had reached an agreement to slash tariffs for the next 90 days, easing trade war tensions between the two largest economies and lowering concerns over the negative impact that the trade war was having on the global economic outlook. As part of the agreement, the United States will lower its tariff on Chinese goods from 145% to 30%, while China will lower its tariffs on US goods from 125% to 10%. The tariff reduction is set to take effect by May 14th, with both sides also agreeing to suspend additional retaliatory measures. The reaction from markets was certainly a positive one, particularly from the financial sector, with major US stock indices such as the S&P 500 and the Nasdaq increasing over 3% on the day. Both countries have committed to the ongoing negotiations to resolve deeper trade issues and avoid decoupling, in another positive step towards reducing overall concerns over the trade wars initiated by the United States. In another set of good news, India and Pakistan announced a ceasefire on the 10th of May, easing tensions between the two countries, which had seen escalating actions over the last week. While the ceasefire remains a fragile one, and already we have seen reports of violations from both sides, the de-escalation has been an important step in lowering tensions in the region and around the world. Then lastly, details of the draft law on EU gas storage levels was recently reported on, with the main points being: 1, a reduction in the storage filling target from 90% to 83%. Secondly, adding a flexible timing deadline to reach those targets from now the 1st of October through the 1st of December. And importantly, allowing European member states at limited deviations from those targets in case of market disruptions. But it must be said that though at least 75% storages must be filled. The aim of the measures is to help lower gas prices and reduce market speculation, which had been a concern across the European gas markets, while at the same time continuing to maintain the security of supply. Now the next step will be for the measures to be negotiated with the Council presidency, and that will begin starting on May 13th. Weather. Looking at the latest weather forecast, we know slightly cooler temperatures at the beginning of the week, but as we move further deeper into this week, and certainly once we look into the following week, the forecast indicates above average temperatures across most of Europe. Precipitation, on the other hand, is set to weaken this week compared to the previous weeks, particularly in the Nordic region, which is seeing a drier weather forecast than before. And then last, in terms of wind speeds, we do see a slight uptick in wind speed starting this Thursday, which could provide a boost to European wind power generation. Macroeconomics. Looking at the macroeconomic outlook with some of the latest figures we have that have been released, starting with the service sector PMIs for the euro area, which showed a slight decrease of 0.9 points to just 50.1 as of April. On the other hand, the manufacturing sector did see a slight improvement. We're up to 49 points, and overall the European economy continues to move in a positive direction. Crude oil and LPG. Looking at crude oil prices, here we can see a slight uptick in the price level over the past week, with WTI and Brent crude oil prices increasing around 4.5% over the past week. The uptick in the market is certainly being driven by optimism regarding the improvement in the relationship between the US and China, as trade tensions have eased, leading into increase in terms of global oil demand expectations. On the other hand, the increases in the price level are being very much limited by the improved supply outlook, as OPEC Plus continues to be set on increasing production quotas starting in June. Looking at the global petroleum balance outlook by the EIA, we certainly note the expectations of an oversupplied oil market throughout the remainder of 2025 and 2026, very much weighing on global crude oil prices. Natural gas. Looking at the TTF price evolution as a reference for European gas prices, here we see a further uptick in the market over the past week across 2025 products and the forward years. The forward year, for example, saw an uptick of 4.8%. The main drivers of the uptick in the market are certainly the improved economic outlook, in part driven by the announcement of the reduction in tariffs between the US and China, which could bode well for the EU and US negotiations on trade. At the same time, the uptick could also been driven by some opportunistic buying for market participants as prices had dropped to quite attractive levels, and certainly compared to the price levels that we had been seeing earlier in the year. European gas storage levels did increase slightly over the last week, although at a slower pace than previously, ending the week at just under 43% full. The slower injection rate meant that the storage deficit versus the previous year remained relatively stable at around 22%. Taking a closer look at the injection rate over the past week, we certainly note that decrease from around 4 terawatt hours per day to a little over 3 terawatt hours per day this past week. The reduction still means that overall injection rates are in line with the average since 2012 and above last year's level, but certainly no longer at the top of the range. The reduction in injections into storage was largely driven by an uptick in total demand, as well as a slight decrease in the total supply picture, as you can see here. Nonetheless, total supply does remain higher than it was last year and really stable over the last few months, while total demand is similarly at the lower end of the range since at least 2019. Looking at the European gas supply mix, there we note the reduction in Norwegian gas flows into Europe, with a slight uptick in LNG sendouts as a response in order to meet overall demand. Nonetheless, the expectation is for the Norwegian gas flows to increase in the coming days, as the reduction in flows was only a temporary decrease. On the other hand, LNG sendouts are expected to continue decreasing in line with the trend of the previous years, especially as we have continued to see LNG importing to Europe decrease over the last week. The decrease in LNG imports into Europe is in part driven by the lower overall consumption of natural gas in Europe, but also a reflection of the price level competition between Europe and Asia. As you can see here, over the previous week, we did note a larger spread between the Asian and European gas pricing, incentivizing additional exports to Asia. Now, given the uptick in the market that we saw over the past week on current price levels, we have seen that premium narrow significantly, as a result, placing European consumers in a more favorable position to securing particularly US LNG exports. Then, looking at the TTF futures investment fund positions, we note a continued decrease in the level of net long positions, partly driven by the lower overall consumption levels in Europe compared to previous years, as well as the ongoing economic uncertainty for the European economy and how that could potentially negatively impact overall gas demand in Europe. Coal. Looking at coal prices here, we note the relatively small movements over the past week, with price levels remaining relatively stable week over week. Any upward pressure that we do see in the market is very much being weighed down by the healthy global supply level and also the very strong domestic production out of China, further limiting demand from the world's largest importer. In terms of European demand for imports, we are seeing coal consumption from the power sector in particular multi-year lows due to low demand, resulting in fewer imports coming into Europe this year compared to previous years. EU and UK emission allowances. In terms of emission allowances, we've seen a further uptick in the European market, with prices increasing 2.4% over the past week. Over in the UK side, we've seen a stronger upward movement in the market, with increases of around 3.5% week over week. The upward movement in the carbon allowance markets has certainly been driven by the slight improvement in the economic outlook, particularly as trade tensions appear to be easing with the US and its trading partners, notably seen by the agreement between US and China. Additionally, particularly for the European allowances, we did see a slight uptick in the consumption of natural gas in Europe, potentially leading to some additional demand for carbon allowances, as well as a slight reduction in renewable power generation over the past week there too. Over in the UK side of things, as we've mentioned before, we continue to see the prospect of a recoupling of the EU and UK markets continuing to support prices. Looking at power sector emissions, we did see a slight uptick over the last week in terms of overall European power sector emissions, but nonetheless, the downward trend over the last few weeks and months continues to hold, with European power sector emissions at the low end of the range of 2019 through 2024. As we look further ahead, and particularly during the summer months, the prospect of record high solar power generation is further reducing some expectations for power sector emissions. Looking at the investment fund positions, there we did see a slight uptick in the net long positions seen for European allowance futures, and that's been largely driven by the slightly more optimistic economic outlook that we've seen over the past week, which could then lead to slightly higher overall emission production, as a result, demand for carbon allowances. Over in the UK, we continue to see record high levels of net long positions, largely driven by the prospect of the recoupling of the European and UK markets. Electricity. Looking at electricity markets there, we see a similar price evolution as with natural gas, with an uptick in the price level over the past week throughout 2025 and 2026. On top of the uptick in natural gas prices driving the upward movement in the electricity sector, we also see the uptick in carbon allowance pricing have an influence there. Looking at the price evolution across European countries, there we see most markets showing a similar price evolution, with some exceptions, particularly looking at France and Spain there. In France, driven by an improvement in the nuclear power output, reducing the impact of natural gas pricing on electricity prices. And over in Spain, we also note the improved renewable power generation outlook weighing on pricing. Over in the Nordic region, we just want to highlight what we mentioned earlier, which is that the drier weather outlook for the region is also decreasing the expectations for hydro storage levels throughout the summer, eating into the upward movement that we're seeing in prices there. Looking at total demand and residual load there, over the past week, we saw a reduction in total grid demand to multi-year lows there as well. Looking at the European supply mix, we did see a slight uptick in the share of nuclear, while the share of wind continues to come down. On the other hand, particularly looking at solar power generation, we continue to see very high levels of output, and as we look to the summer, the expectation that we'll reach new record highs this year. Looking at nuclear power generation, we see that the uptick in total European nuclear generation was primarily driven by the increasing the output from the French nuclear fleet, as some maintenance got wrapped up and more reactors were operational. Looking at renewable power generation next, we definitely see that reduction in output over the past week, while fossil fuel power generation remained relatively stable week over week. In terms of renewables, the main drivers of the decrease in total output was both wind and solar power generation. On the other hand, while we did see a reduction in solar power generation, it did remain near the highest levels for this time of the year over the last 6 years, while wind power generation was near the lowest levels we've seen over the same period of time. In terms of fossil fuel power generation, we did see that continued decrease in their overall level, pushing it closer to the lowest levels over the last 6 years. Then looking at hydro storage levels, while we do see very high levels, particularly in the Nordic region, the drier weather outlook we mentioned earlier could begin reducing the hydro level excess versus the average over the last 10 years. Lastly, looking at the guarantees of origin price evolution, we note further bearishness over the past week, with prices decreasing across technologies and across years of production, primarily driven by some of the improved output we're seeing so far this year, but also the expected increase in capacities in the coming years, helping to increase total renewable power output. That covers this week's market presentation. Thank you for joining.